What if I told you that while 90% of investors lose money in the stock market, there's a proven strategy that has created more millionaires than any other investment approach in history? Today, we're diving deep into the principles that transformed ordinary people into financial legends. Welcome to your journey into intelligent investing. I'm about to share the exact principles from Benjamin Graham's legendary book, The Intelligent Investor. The same principles Warren Buffett used to build his $100 billion fortune. But here's the thing. Most people completely misunderstand what intelligent investing actually means. If you want to learn how to build real, lasting wealth instead of gambling your money away, make sure to hit that like button right now and subscribe with notifications on, because what you're about to learn could change your financial future forever. Let's start with the most important concept that separates intelligent investors from speculators. Benjamin Graham, known as the father of value investing, made a crucial distinction that most people completely ignore. An intelligent investor focuses on the long-term value of businesses, while a speculator tries to predict short-term price movements. Think of it this way. An investor buys a piece of a business because they believe in its future earnings, while a speculator buys a stock hoping someone else will pay more for it tomorrow. Here's Graham's famous analogy that will change how you think about the stock market forever. Imagine you own a business with a partner named Mr. Market. Every single day, Mr. Market comes to you with an offer to either buy your share of the business or sell you his share. Some days, Mr. Market is optimistic and offers you a high price. Other days, he's pessimistic and offers a low price. The key insight. The true value of your business doesn't change just because Mr. Market's mood changes. As an intelligent investor, you should only sell when Mr. Market offers you significantly more than what the business is worth, and only buy when he offers you significantly less. Now, let's talk about the most important concept in all of investing, the margin of safety. This principle comes from engineering, where bridges are built to handle much more weight than they'll ever need to carry. In investing, margin of safety means never paying full price for a stock. You want to buy stocks trading for significantly less than their intrinsic value. But how do you calculate intrinsic value? Graham gave us specific criteria. For stocks, he looked for companies trading at less than 15 times earnings, with debt no more than 110% of current assets, and with earnings growth over the past 10 years. But here's the secret most people miss. It's not just about the numbers. You need to understand the business model. Can you explain what the company does to a 10-year-old? Does it have competitive advantages that protect it from competitors? Warren Buffett calls this an economic moat. Think of companies like Coca-Cola or Apple, that have brand power so strong that competitors can't easily replicate their success. The margin of safety protects you from two things: errors in your analysis and bad luck. If you buy a stock worth $100 for $60, even if you're wrong and it's only worth $80, you're still profitable. This is why intelligent investors can sleep peacefully at night while speculators stay awake watching price movements. Graham identified two types of intelligent investors, and understanding which one you are is crucial for your success. The defensive investor and the enterprising investor. The defensive investor wants good results with minimal effort and minimal risk. This isn't about being scared. It's about being realistic about how much time and energy you can dedicate to investment research. For defensive investors, Graham recommended a simple but powerful strategy. Split your portfolio between high-grade bonds and dividend-paying stocks. The exact split should vary between 25% to 75% in either direction based on market conditions. When stocks are expensive, hold more bonds. When stocks are cheap, hold more stocks. The enterprising investor is willing to put in significant time and effort to achieve superior returns. They're not just buying index funds, they're analyzing individual companies, reading financial statements, and making calculated bets on undervalued opportunities. But here's Graham's warning that most people ignore. Being enterprising requires actual skill and dedication. You can't just pick random stocks and expect better results. You need to develop genuine expertise in business analysis, or you're better off being a defensive investor. Let's get practical. How do you actually implement these principles? First, you need to develop what Graham called emotional discipline. The biggest enemy of intelligent investing isn't market crashes. It's your own emotions. During bull markets, when everyone's getting rich quick, you'll be tempted to abandon your principles and chase hot stocks. During bear markets, when everyone's panicking, you'll want to sell everything. The intelligent investor does the opposite. They stay calm during euphoria and stay brave during panic. Here's a practical framework you can use starting today. Before buying any stock, ask yourself 3 questions. First, do I understand this business well enough to predict its earnings 5 years from now? Second, is it trading for significantly less than it's worth? Third, does management have a track record of creating shareholder value? If you can't confidently answer yes to all 3, don't buy it. This simple filter will save you from more mistakes than any complex analysis ever could. For defensive investors, Graham recommended focusing on large, established companies with long histories of dividend payments. Think utilities, consumer staples, and blue-chip stocks that have survived multiple economic cycles. For enterprising investors, look for special situations, companies going through temporary difficulties that don't affect their long-term prospects, spin-offs that the market hasn't properly valued, or small companies with strong competitive positions that haven't been discovered yet. Now, let's talk about the mistakes that destroy even intelligent investors. The first mistake is thinking you're smarter than the market. The market isn't always rational, but it's not stupid either. If a stock looks like an obvious bargain, ask yourself why nobody else has noticed. The second mistake is falling in love with your stocks. Every stock you own should be constantly competing for space in your portfolio. Just because you made money on a stock doesn't mean you should hold it forever. Just because you lost money doesn't mean you should hold it until it comes back. The third mistake is trying to time the market. Graham was clear about this. You can't consistently predict short-term market movements, and trying to do so turns you from an investor into a speculator. Instead of timing the market, time your purchases within your overall allocation strategy. If your target is 60% stocks and market volatility has pushed you to 45% stocks, gradually buy more. If you're at 75% stocks because of market gains, gradually take some profits. The fourth mistake is diversifying incorrectly. Owning 50 different technology stocks isn't diversification. It's concentrated risk with extra complexity. True diversification means owning different types of businesses that respond differently to economic conditions. Here's what Graham understood that most investment advice misses. Successful investing is more about psychology than mathematics. The biggest returns don't come from finding the perfect stock. They come from avoiding the mistakes that destroy wealth. Think about it this way: if you can avoid losing money during market panics, you don't need to make spectacular gains to build wealth. A 10% annual return compounded over 30 years turns $10,000 into $175,000. But here's the key. You have to actually achieve that 10% consistently, not lose 50% in bad years trying to make 30% in good years. This is why Graham emphasized temperament over intellect. You don't need to be a genius to be a successful investor. You need to be patient, disciplined, and rational. You need to do boring things consistently, rather than exciting things occasionally. The wealthy understand something that the average person doesn't. Wealth isn't built through home runs, it's built through consistently getting on base. Every dollar you don't lose to a bad investment is a dollar that can compound for decades. Graham's student Warren Buffett puts it perfectly. Risk comes from not knowing what you're doing. The antidote to risk isn't diversification or complex hedging strategies, it's knowledge and discipline. Let's put this all together into a plan you can implement immediately. Step 1. Decide whether you're a defensive or enterprising investor. Be honest about how much time and energy you can realistically dedicate to investment research. Step 2. Set your asset allocation based on your age, risk tolerance, and market conditions. A simple rule: your bond percentage should roughly equal your age, but never less than 25% or more than 75%. Step 3. If you're defensive, focus on low-cost index funds and dividend-paying stocks of established companies. If you're enterprising, develop expertise in specific industries and look for undervalued opportunities within your circle of competence. Step 4. Implement dollar-cost averaging. Instead of trying to time your investments perfectly, invest the same amount regularly regardless of market conditions. This removes emotion from the equation and takes advantage of market volatility. Step 5. Review and rebalance quarterly, not daily. Check that your allocation matches your targets and make adjustments if you've drifted significantly. Resist the urge to make changes based on market news or predictions. Remember, the goal isn't to beat the market every year, it's to participate in the long-term growth of productive businesses while avoiding the mistakes that destroy wealth. The principles we've covered today aren't just theory, they're the exact strategies used by the most successful investors in history. Benjamin Graham didn't just write about these concepts, he lived them. And his students like Warren Buffett proved they work in practice. The beautiful thing about intelligent investing is that it doesn't require special talents or insider information. It requires discipline, patience, and the wisdom to buy when others are selling and hold when others are panicking. The choice is yours. You can continue gambling with your financial future, chasing hot tips and market predictions, or you can start building real wealth using principles that have worked for nearly a century. Your future self will thank you for the decision you make today. The best time to plant a tree was 20 years ago. The second best time is right now. If this video has opened your eyes to what intelligent investing really means, show your support by hitting that like button. It helps more people discover these life-changing principles. Subscribe and ring that notification bell because your financial education journey is just beginning. The path to financial freedom isn't complicated, but it does require commitment. Take the first step today and let compound interest work its magic over time. Your wealthy future self is waiting. Thank you for investing in your financial education. Remember, intelligence plus discipline equals wealth.